Hey everybody, it's Larry Berman here. Feeling a little bit under the weather. Last weekend, apologize for not being able to get a video out to you. We did record one. It was a remote from the golf show in Orlando, and the internet connection was terrible, and my producers decided not to use it. So obviously a crazy week this week with the Fed and crazy set of data, everything from massive divergence in the payrolls report from expectations to how the market behaved to expectations for the QRA, all kinds of analysis. And then, of course, Powell's, pushing back on a March rate cut. And the market is just defying him. And apparently he's going to speak on Sunday night on 60 Minutes. And from what I've heard, he's already recorded that, having the payroll data already in hand on Thursday night. So who knows? Markets are always full of rumors. But when we look into the chart room, let's see what we learned this week. So when the headlines hit for the employment report at 8:30 on Friday, it was shocking. S&P at that point was up about 1% going into it, with the NASDAQ up about pretty close to 1.5%. Very quickly sold off, where the S&P was close to unchanged on the day. But with the big gains in a handful of tech stocks, the NASDAQ was still up. I don't think at any point during the day it got to, say, less than, up 0.5%. But into the market open, we just ground. It just went up all day. And, you heard stories about gamma squeezes, and you heard all kinds of things like that on Friday. When you look at what's priced into the markets in terms of rate cuts, you see less than certainty that we get a rate cut before June. So there's still some room for rate cuts in March. There's almost certainty in a rate cut by May. And by the time we get to June, they're thinking of 2 rate cuts. So, probably one at the May meeting and then one every meeting since that. What did happen this week is that we priced out about half a move. Most of that came on Friday's payroll report. A little bit came after Powell's Q&A. We'll see what Sunday night brings, but the equity market at this point just doesn't care. Andy Constant is someone we followed with an eye on the Fed and Treasury supply and what that means. And he says Wall Street seems to have the interpretation wrong about the impact on supply, and is pounding his fist that the new bonds coming in the next few months would have a big negative impact on asset markets. When we look under the hood, year-to-date basis, and we see what's up, clearly what's leading is the NASDAQ 100. So we have the Qs that on a year-to-date basis on Friday's close had a total return 4.76%. The broad U.S. market cap weighted, up 3.36%. The equal weight S&P 500 up 22 basis points. So basically, stocks are flat on the year, except for large cap tech and a handful of them, to be sure. When we look at other asset markets, U.S. small caps Russell 2000 is down south of 3% this year, IWM. The U.S. long bond is down 2.5%. A lot of that was on Friday. We saw a bit of a clawback in rates towards the end of the month into February, But after that payroll report, obviously bonds weren't going to be in the rally mode anymore. And then broad commodity markets, DBC, ETF, down on the year. So assets in general and on average are down, and it's AI and big tech that are leading it. When we look into earnings, with more than half of the S&P 500 already reporting, the companies that are doing the lifting in earnings, remember, year-on-year earnings growth is expected to be pretty nominal this year. It's coming from a very concentrated group of stocks where the average stock this year is not going to have any earnings growth. So you have a really bifurcated market. How long it will continue? Well, that's anybody's guess. When we look into the market breadth indicators, again, globally, average stock is down this year. Market breadth, even on Friday, when you look at the tape, you say S&P up 1%, NASDAQ up 1.7. You say, wow, that's a good day. We should have good market breadth. On the Dow, you have 13 advancers and 16 decliners. Broad S&P, we're worse than neutral. NASDAQ, worse than neutral. So this is not a robust rally, and you've got to question it. Again, having said that, I've been cautious for months now. I do believe Treasury supply and all that debt is going to matter, but it's being dwarfed right now by AI. AI is in the first inning. There's years to go here. Question is, do you want to pay for all of that today? And, my answer is no. If you're a momentum investor, this is a great market. You're buying what's going up. You keeps going up. You keep buying more. Eventually, you're a bag holder. So when is that turning point coming? I have no idea. You would think, though, as we get into bond supply in the next few months, that we'll see what happens there. What else is there that's going to upset the apple cart here in terms of hitting big tech? Other than running out of buyers, I'm not sure, frankly. So the AI phenomenon, theme, trend, whatever you want to call it, is going to turn into a bubble. I could argue it's not going to be bigger than the dot-com bubble because, tech is well established and known. But what people are willing to pay for the future earnings today, that bubble-ish kind of development is what we're needing to debate, and its influence on the broader indexes. I still think this is a year where you want to be a stock picker. When you look at, more stress on the regional banks, New York Community Bank this year that bought into the failed bank a year ago, March, struggling. That rippled through the financials. Obviously, there's a big weight in financials in the small cap universe and so forth. So, that higher for longer narrative, the Fed is not going to be easing as much as the market is asking for, is still there. So, that's a debate today, and it's a tough one. This is a very, very difficult market. Anyways, be cautious out there, folks. I don't have anything else for you. I'll be back in Toronto next week. Hopefully, if this cold goes away, I'll be live on BNN on Monday. Have a great week, everyone.